Hello and welcome to this live programme from Baillie, Gifford, where we're talking today with Stephen Pace. Stephen is Head of European Equities at Baillie Gifford and co-manages the company's European Growth Trust, which has assets of around £400 million. My name is Richard Lander from Citywire, and I'll be talking to Stephen about how he runs the trust for about 25 minutes. We'll then be taking your questions, which you can submit at any time via the Q&A box in Zoom. So welcome, Stephen, and thank you for joining us today. Let's start off with the hard, cold facts as a growth manager for the last 6 months or so. It's not been an easy time. We've had a huge rotation into value. Why did this happen so quickly after such a great period for growth?
Well, I mean, it's a pretty topical question just now. I mean, look, it's never easy, I don't think, being a growth manager, certainly in Europe. And I remember the first question that I got this time last year, which was really on why Europe had lost significance as an asset class. But I think part of the reason why we've seen a bit of a sell-off is partly because we have seen a prolonged period of above average returns. And if you were to look at, for instance, our European fund, which we've been managing since 1985, over the last decade up until the end of the year, we had generated something like about a 17% return per annum. And while that was very good, the market also produced something pretty decent in a return of about 12% per annum for a decade. And these kind of returns are above what we would expect long-term equity returns to be. So I think we've all benefited from, obviously, the structural tailwinds for this. We have seen, obviously, a period of low interest rates. We've seen increasing innovation. And when we kind of came through COVID, we saw quite a quick recovery. And when you pull these things together, it provided a lot of support for equity valuations. And at least I think at this point last year, I think that support for equity valuations had turned into a bit of euphoria. You'll remember this time last year we had a lot of meme stocks being bid up by a lot of retail investors. But as we went through the year, certainly by November, the supply chain problems as a result of COVID started to feed through into inflation. That inflation hasn't turned out to be as transitory as some of the commentators were telling us. And that obviously led the central banks to increase the kind of rhetoric and implement the start of the rate cycle. And I think that has obviously had an effect on growth stocks and long duration assets. Now, more recently, we've had the quite horrific invasion of Ukraine and the impact not on just society and kind of the Ukrainian people, but also energy prices, which is also feeding into inflation. So I think there's been a culmination of things which has turned that euphoria, which we saw last year, into panic. And when you get these things, and as we know, the biggest determinant of share prices and valuation multiples over short periods of time is emotion, and it's investor sentiment. And I think when you've got this kind of panic in markets, this is when you see volatility, which is nothing normal, which is nothing unusual, kind of appear in stock markets at kind of really elevated levels.
Right. So we've got a mixture of things, return to the mean, to extraordinary events in the shape of COVID and the Russian invasion of Ukraine. Some would say that all this has precipitated perhaps the end of globalization, again, another big driver in growth over the last decade. And that is a secular change, not just a cyclical one. Do you think that's the case? We've reached a point in history where things are changing fundamentally?
I do have some sympathy for that. And it's not even just with the recent war in Europe. I mean, this probably started a while back. I mean, obviously, we've had trade wars in the past. We had Brexit. And I think the supply chain shock and the bottlenecks resulting from COVID and then obviously the Ukrainian crisis here has led to kind of some people talking more about onshoring, reshoring of a lot of industries. So I actually think, particularly for those industries which are of strategic importance, I think we are going to see some profound changes that will affect markets over the coming years and decades. But I guess, like most big changes to kind of what are complex adaptive systems like global trade, economies, and stock markets, we're going to get winners and losers, as we've always had. And I think a couple of examples there that we would then think about being, let's say, beneficiaries of this change would be companies like Northvolt, which is one of our largest positions as a private company. Actually, it's a Swedish company which manufactures green electric vehicle batteries, and it was set up by a couple of ex-Tesla employees, kind of harnessing the low hydroelectric power they get in Sweden, and it's got an aspiration of providing Europe with about 25% of its battery supply by the end of the decade. Now, in the current climate, it seems even more obvious that Northvolt is of extreme strategic importance to the European economy and its industries. And I think that's why there's so much support for companies like Northvolt that will be able to supply electric vehicle batteries, but other batteries for other applications, which will enable the European auto OEMs, for instance, to not have to rely on the supply from Asia. There are other companies like ASML, which is a European lithography tool provider. So it manufactures lithography tools, which are then sold to mostly Asian companies to manufacture semiconductors. But we're starting to see other regions accelerate their investment into building out their own semiconductor supply chains. We've seen, certainly in Europe, kind of politicians talking about trying to get to a 20% market share. We've seen the US CHIPS Act, where it's allocated more than $50 billion US dollars to try and build out more capacity. And we've seen similar investment aspirations in Japan as well. So we're seeing lots of industries try to kind of secure their independence. And I think that's going to play into the hands of some companies, and obviously some companies are going to lose out.
Right, okay. Just to return to this sort of period that we've had of growth going to value, I mean, how indiscriminate was the sell-off? Did you find when you saw your screens every day that the good stuff was being just thrown out of the window along with the bad stuff?
I think to an extent that was true for a period, particularly over the last month or two, when we've had quite a volatile period, being affected by the kind of circumstances in Europe as well, and coming in and seeing just basically everything that we own being sold off quite aggressively. And it hadn't even been, I mean, typically when you see interest rates go up as well, or the expectation of interest rates go up as well, you see long duration assets in companies that are going to generate most of their value and profits sometime in the future get sold off more. But actually, we had a mixture of companies which were very profitable and which are very profitable, selling off just as much as those companies, well, the relatively small number of companies I might add, companies in the portfolio that are not making a profit at the moment. So we started to see quite a big opportunity there, where some of the companies that we hold in the portfolio had sold off 50, 60%. And I think in terms of being indiscriminate, I think it was those companies where you have to kind of think longer term about the potential for them to make money and the amount of value they may create in 5 or 10 years. And I think in any environment, as we're in just now, investors typically become much more myopic. They're much more interested in what's going to happen over the next coming quarters, what the balance sheet profile is like over the next kind of 12 months. And anything that requires a bit of imagination or to think through a lot of the uncertainties just get sold off quite aggressively. And we had a number of these companies, some of the food delivery companies that we own. So we've got companies like Just Eat Takeaway and obviously Delivery Hero. And I think the market for these companies, because they're not yet profitable, basically just got in a bit of a panic, I think. But actually, when you think about the growth potential for these companies, so Just Eat Takeaway is generating almost 30 billion in gross transaction value. So this is all the orders that they accumulate and generate within their markets. And it wants to double that GTV value, or the gross transaction value, in the next 5 years. So there's going to be significant growth for these companies. And at the same time, when it reaches that kind of scale, we fully expect that company to be profitable, as it's shown to be in a number of its regions where it has very dominant positions like Germany and the Netherlands. And I would say the same for Delivery Hero. I think the market is focused a little bit too much on kind of the next 12 months, whether the GTV is going to be 44 or 45 billion, where the operating margin is going to be in the next 12 months. But people forget that for companies like this, they have an aspiration to reach 200 or 350 billion in transaction value by the end of the decade. But I think because of the circumstances, investors just tend to put that in the too hard pile, and they focus on more defensive companies, things which are kind of relatively safe, at least in the short term. So I think it has thrown up a number of opportunities for us to add to things that we know very well, which are already in the portfolio.
Right. So what do you do? It's the old saying, if you love this stock at £20, you'll adore it at £10. You there as a fund manager, do you go out and buy more of the same stocks, or do you deploy cash to new positions? What's your thinking when you've been through a traumatic market period like you've seen over the last few months?
Sure. And we've gone through periods of volatility like this before. I mean, obviously the circumstances are slightly different, but over the last 10, 15 years, obviously we've had the European sovereign debt crisis, we've had trade wars, we've had COVID, we've had all sorts of problems to deal with, particularly when it comes to the European markets. But we do the same. It's the same process that we follow every single year. And it's for these companies that are performing well, but also for the companies that don't perform so well over short periods of time. And that's that we periodically will update our view on the underlying fundamentals of all the companies in the portfolio and the likelihood and probabilities of us generating at least a 2x return over the next 5 years. So we do this for all of the companies in the portfolio. And when we spot inefficiencies in the market, or when we can take advantage of short-termism feeding through to increased volatility, we will typically add to companies that we think have been unfairly sold off within the portfolio. These are companies that we have got to know very well. Some of these companies, our turnover is typically 20% or lower. So we're holding these companies typically for 5 years or longer. But in reality, some of these companies we will hold for decades. And when you get to know these companies, you should be in a better position to understand the future prospects and take advantage of this mispricing in the market. So most of the kind of the transactions we've done over the last few months have been to add to companies that we know already and very well. Companies like Just Eat Takeaway, Delivery Hero. We've also added to Allegro, which is a Polish e-commerce platform. So we're taking advantage of that volatility. But we have also been looking for new opportunities. We've added to 2 new companies over the last few months. One being a company called Nexans. So this is a French industrial conglomerate which sells lots of cables to lots of different industries. Some are more commoditized and generating fairly low margins, but the real attraction for Nexans is that it has a leading position in supplying copper cabling to the high voltage subsea market for offshore wind. And offshore wind is an area I think is going to be particularly attractive for long-term growth investors, given the underlying dynamics. And that's a company which is also going through a bit of a transition where it's going to sell off a lot of its low margin commoditized businesses and reinvest in this higher growth, higher margin copper cabling business. So if that happens, we're hopefully going to see a lot of value being created by that company over the next 5 or 10 years. The other company we bought more recently is another private company called McMackler. This is a German real estate broker which was founded in 2015. And the simple investment case is that it is using software and technology to make the buying and selling of homes within Germany and France and some other regions much more efficient, with much better levels of service. And it's competing against a lot of very old-fashioned, traditional, small brokerages across those various regions. And again, when we go through the framework that we use to assess growth, the competitive edge, the alignment and sustainability, and obviously valuation, can we have a decent chance of generating at least a 2x return over 5 years? It kind of ticked all those boxes. So this is another one where we're kind of trying to look out at what these companies could look like in 5 or 10 years and take advantage of that.
Right. Have you also had the time, you've mentioned a couple of new areas there, have you also had the time to sort of sit back and think about what are going to be the next breakthrough areas that you might not be investing in right now, but you're keeping an eye on, sectors to do with decarbonization or climate change and so on?
Yeah. I think we've been looking at climate change for a while, but I really think that we're at a tipping point for, let's call it decarbonization capex or companies that enable this energy transition. The energy transition is now turned into energy independence in Europe. Europe relies on Russia for 45% of its gas, and also oil and coal to a lesser extent. So I think the European Commission has really got the bit between its teeth. And not only does it want independence from Russia by the end of the decade, it also wants to increase the investment into solar panels, heat pumps, which we have exposure to through a company called NIBE, hydrogen capacity. It's speeding up the permitting process for renewables, biomethane, and obviously LNG. We have to source LNG from other suppliers now. So I think looking at some of these areas is going to be hopefully quite fruitful. As I said, we've been looking at this area for a while now, and like all big trends of the last couple of decades, whether it's kind of industrialization in China, the tech boom, the rise of the Chinese consumer, big tech platforms and network effects, these themes are pretty obvious. However, the hardest bit is actually finding the right companies which are going to generate value over long periods of time. Mm-hmm. And we've seen a lot of hype around some of these technologies before, whether it's 3D printing, solar, fuel cells, and because of competitive dynamics, cost or price deflation, technology maybe not living up to expectations. Not all of these areas have actually been particularly fruitful for investors. So I think we're spending a bit more time trying to really pick through the areas where we think that there are supportive dynamics at play. And I think maybe if we could pick out one, it would probably be offshore wind. And this is why we looked so favourably at the company I mentioned, Nexans. But we're spending a bit more time on offshore wind and trying to understand the dynamics there. It's more of an oligopoly. There's a servicing element to it. And I think looking at the capacity which is needed in offshore wind over the next decade, which will probably see growth rates of 20 to 30%, this is going to be an area of importance. And I think we're going to spend a bit more time on that. And at the same time, we're speaking to the existing companies in the portfolio which are driving this climate change and decarbonisation. We've got holdings in companies like Aker Horizons, which is the renewables holding company of the Norwegian oil and gas parent Aker. We've got companies like NIBE, which I mentioned, which is involved in heat pumps And again, the penetration rates of heat pumps are very, very low across most of Europe and the US, and we expect these to rise. And companies like Atlas Copco, which is a Swedish industrial which manufactures extremely energy efficient air compressors and vacuum pumps, and even companies like Kingspan, which manufacture insulated boards and panels. So we've got lots of ways to kind of play this theme, but trying to kind of think of other areas where we're going to see asymmetry and huge returns is something that we're going to keep focusing on.
But you feel there's enough entrepreneurial companies out there to absorb the money that you want to invest in them? Europe is often accused of not fostering the right spirit for these companies to grow. Do you think that's still the case?
I think the perception of Europe being a bit of a backwater when it comes to innovation and kind of building entrepreneurial companies is still there. And I still maintain that is the wrong way to think of Europe. I think obviously when you look at Europe from the top down and think about the economy, kind of the political kind of problems that we have, yes, we do have some issues. But when you look at it from the bottom up, when you think about the funding environment for European companies, and a lot of this is coming from private markets, venture capital. We saw, I think it was more than 100 billion invested in European tech companies in the private markets last year. So the supportive tailwinds in terms of funding, in terms of having some role models in public markets like Spotify, like some of the delivery platform companies, like Adyen, which is a Dutch payments infrastructure company. When we have these things put together, we have this now transition and period where we're going to see a lot more ambition come through, and a lot more of these small innovative companies coming through private markets and then coming into the public markets, which will drive hopefully this perception to change and actually show that Europe has what it takes to build out these world-class technology companies.
Right. You mentioned a number of the private companies you invest in there, and obviously over time it's become a bigger and bigger part of the trust. Are you intending to keep growing the private portion, or are you just going to treat them on a level playing field with the public companies and find the best opportunities wherever they are?
Yeah, I mean, we will try and find the best opportunities regardless of whether they're private, whether they're public. It doesn't matter to us where they're listed within Europe. Or what sector, as long as we think they're able to grow and have huge markets to grow into. These companies also need to have very strong competitive positions. Obviously, growth is pointless without some kind of barrier to entry and kind of edge. We want these companies to have long-term and long kind of investment horizon thinking insiders, whether it's founders or families. And we want each of these investments to have the ability to generate at least a 2x return over a 5-year period, but hopefully do a lot more than that. But when it comes to the private companies, and this is something that we've only been doing within the trust for 2 or so years since we took the mandate over, we started off with a kind of a limit of 10%. We could invest up to 10% of our total assets into private companies. And the recent AGM, we requested and had approved the ability to move up. So we can now invest up to 20% into private companies. Now, we're not going to run out and just fill up that 20% with the first private companies we come across. We're going to take our time. We're going to be very patient. But I think it's reflective of the opportunity set that exists in the private space to find these future big winners, which is kind of driven us to ask for this. And I think, if anything, the idea generation is slightly different when it comes to private markets. And I think it's the relationships that we have amongst growth companies, amongst founders and entrepreneurs within Europe, which is actually generating more ideas that are coming to us rather than us having to go out and find them. And when you're kind of investing in private markets, a lot of it is about who you know and your reputation, and being able to get an invite to the table to speak to some of these fantastic people and founders. And I think, if anything, our competitive position is even stronger in private markets than it is in public markets, which is why we're so excited about it. So we'll see this play through. We only have 4 companies, private companies at the moment in the portfolio, but hopefully we'll be able to find some more of those over the coming years. And given the nature of asymmetry in stock markets, we only really need one of these companies to really hit it big for it to make a massive difference to the portfolio. And I think that hopefully will be the case.
Right. Do you find yourself having to temper your enthusiasm for private companies? There is so much money chasing it from the VCs, who are just awash with cash, that they're prepared to pay almost anything for valuations in the private market. So do you have to restrain yourself sometimes when things get a bit too frothy?
Yeah, but that's the same for both private and public. I mean, certainly last year as well in public markets, we saw a lot of money being invested in companies where the valuations had run ahead of fundamentals, and this was in some cases some of those climate change champion companies that I mentioned. So I don't think it kind of really matters that there are going to be overpriced companies in both sides of the IPO line. So it just has to come back to the same process that we use for any company. We have to go through our due diligence. We spend a lot of time meeting the companies. We have a kind of a 10-question framework that we will go through for every single investment. And again, it's focused on growth, its competitive edge, its alignments and sustainability and valuation. And we have to be aware that in some areas that there is a lot of money being put to work. That may also be changing. And I think certainly going back to the examples of food delivery, that there was a lot of private money being thrown around those markets. And I think the feedback that we're getting now is actually that the competitive environment is becoming a bit more rational. And I think the narrative for a lot of these companies is now, okay, let's show the stock market that we can pull these levers and become profitable now that we've built up scale. So I think there's certain areas that will benefit as well from an absence of capital being thrown at these areas as well.
Right. So we're going to move on to Q&A from the audience very soon, but just one question generally about, and this is on the psychology of investing, I guess, that investors are notoriously impatient and bad at timing their exit and entry points into the market. Perhaps that's happening now. Why does this happen time after time? You know, people don't learn from history, and how can they be persuaded to act differently going forward?
Yeah, I mean that's the crux of the problem for a lot of investors, and I think ultimately investing is very much a pro-momentum pursuit. Even fund selectors and kind of retail investors, they tend to buy the funds that have performed well over short periods of time. And then when those funds underperform over short periods of time, they then sell them. And that's unfortunately the reason why most fund investors will underperform the market, because they're buying and selling too often, and they're buying and selling at the wrong time, that they're chasing performance. And they're getting caught up on this kind of market psychology and kind of far too much short term kind of in the thinking. But we know that investors need to be patient, and it's really about trying to educate and kind of teach those investors the benefits of being long term, because we know that even the best performing fund managers over a 10-year period will most likely have at least 1 3-year period where they will underperform. And as investors in individual companies, we also are aware through our experience that some of the best performing and biggest winners in our portfolios over the last 10 or 20 years will regularly have drawdowns and fallen value by 40, 50% or more. So we have that kind of experience where we can see that volatility is normal. But if you can find an investment manager and or a company that you trust and you believe in the long-term prospects and the philosophy and the culture, then you have to buy those managers or individual companies and hold on to them for very long periods of time. That is the only way you will be able to benefit from the compounding which exists in financial markets and the asymmetry that we are aware of. So I think that's the advice. Try and be patient and kind of think about those points.
Right. Okay. Thank you. We're going to move on to questions that have been sent in now. So thank you very much for sending these in. One, I'm going to start with this one, that you referred to technologies that succeed and technologies that have disappointed over the years. What's been the one technology this viewer wants to know that has disappointed you and that just hasn't broken through?
Well, I mean, going back a number of years, I mean, it's not really disappointed me because of the impact on the portfolio, because we hadn't really invested in those areas. But solar is kind of a classic technology. I mean, there's a couple of renewable or kind of renewable energy technologies that have had a lot of hype and promise, which some of them have performed admirably and kind of done a lot of good for society, but they've just been rubbish investments. And solar is unfortunately one of them. And it's because it's a fairly commoditized market. So yes, we had an initial spurt where some companies did quite well. We had lots of subsidies in Germany supporting that industry. But over time, as the technology got better and the prices came down, there was huge deflation and lots of overcapacity. And this is one of the reasons why solar hasn't been a particularly good area to invest in. And you could say something similar for a number of other technologies as well. So I think that's probably one of them, solar, which, again, as I said, hasn't been a great investment. The other area which hasn't worked out yet, I think, is gene editing. And we have a number of European companies involved in this space, which, again, if you kind of look at the hype cycle, where we're kind of, you see a lot of hype for things like CAR-Ts, gene therapies. The technology works, but I don't think we've been patient enough as a stock market and set of investors for some of these companies to see really how amazing some of these technologies that have been shown to cure some blood cancers and some other unmet medical needs. And I think we're going to start over the next coming years seeing these biotech companies in Europe as well really fulfill the promise that they have shown in the past. So I think that's a slightly different case. That's an area of technology which just hasn't yet performed, but it's a really exciting area.
Right. Okay. Another question that's just come in. Obviously, you refer to the unprofitable companies such as Just Eat and Delivery Hero. Isn't the problem, this viewer asked, that they just keep pushing out the date of profitability and it never actually arrives?
I don't think so. These two companies in particular have, I mean, let's take Just Eat Takeaway for example. Now, Just Eat Takeaway has 95% market share in food delivery in Germany, and it is very profitable in Germany. And the same goes for the Netherlands, where it started. It has bought a company which we know is called Just Eat in the UK, and it's investing back into growth there. And we can see the improvement come through. So for them, it's more about timing. They can pull the levers that they need to become profitable if they wanted to. But as we've realized, one of the dangers of companies trying to grow at scale is pulling that lever too early, because what they want to do is build up unsaleable market positions in all of these markets, which will enable them to generate a higher absolute level of value over longer periods of time. So when it comes to, again, patience, we speak to these companies all the time. We are very aware of which companies are very profitable for them and which ones they're about to pull the levers to become profitable. So we're not trying to hurry them up. We're not trying to hurry them to become profitable too early. And if you can do that if you believe in the business model. And we fundamentally believe in the business models of both Just Eat Takeaway and Delivery Hero, where, again, in the case of Delivery Hero, it has the same setup. It has a number of regions which are very profitable and a number of countries where they are going to be very profitable. It's just that they're choosing to invest in growth at the moment.
Right. Excellent. Here's a nice question in that, you've talked about the stocks that you like becoming available at cheaper and cheaper prices. Have you had the confidence to increase gearing given your bullishness after these declines? Or do you have enough cash on hand to do this, to buy the stuff you want anyway?
We have, obviously, but just by the mathematics of equity prices going down, the gearing is ticking up a little bit. But we have chosen not to kind of buy back shares, which is another use of capital. At the kind of the discount levels that we're now trading at, I think it's quite an extreme period where actually we would rather use that money and invest in the companies that are in the current portfolio.
Okay. Another question come in. Couple here on private your private holdings. Have you reviewed the prices at which the private holdings are held in the portfolio? Do you feel that you have to strike some of them lower at this moment?
Yeah, so this has been an area of work, and we have quite a disciplined process for this. We have an internal private markets valuation team, and typically they will look at all of the private companies every 3 months, but if there are any kind of exceptional circumstances, they will look at them every month or when these kind of events happen. And we also use an external valuation provider to kind of cross-check that as well. So we have a lot of people, including ourselves, obviously, feeding into this process and looking at valuations in the private companies space. And actually what has happened is that we've not really seen much change in the valuation of private companies. Northvolt, for instance, hasn't changed value. Sender, which is a digital freight forwarder, has actually increased in value slightly. Flix Mobility, which is a marketplace or digital marketplace for transport, has actually fallen slightly. But in aggregate, it's nothing like what we've seen in public market valuation. So this is something that we're looking at and trying to see whether we should be a bit more conservative. But I think from the work that we've done, we're pretty happy with where we are. And then again, when you're kind of taking a step back, we're starting to look at companies like Northvolt, which again in the public, it's in the public domain, so it's not sensitive information. But the reported value was about $11 billion US dollars or something last year when it did its last funding round. We, at the same time as trying to kind of assess whether in the short term these valuations need to be changed, are looking at the probabilities of whether Northvolt is actually a $100 billion US dollar company and what it'll take to get there. And we've seen very similar companies IPO recently. One of them was LG Energy Solutions, which is quite a similar company. It's a bit more mature in terms of the build out of its capacity, but I think it floated at about $80 billion US dollars. So again, when we're looking at these opportunities from the private companies, they're absolutely enormous. And actually, that's what we need to focus on. And you're not going to get any investor or external valuation provider coming up with the types of valuations that we are thinking about. And that's, I think, part of our competitive edge, that we have a completely different process and investment style to anyone else. and hopefully it gives us the opportunities to find and hold these amazing companies and hold them for long periods of time.
Great. Going to wrap up with a couple of questions with reference to what's happening in the Ukraine and the Russian invasion. Firstly, a very straightforward one. Do you have any exposure to Russia?
No. We have no direct exposure to Russia. We have, for instance, a very small, we can look at the revenue that is generated from all of the companies in the portfolio to both the Ukraine and Russia, and it's a very low single-digit percent. We can also look at companies where, let's say, Process, which is one of our largest holdings, it's a consumer technology holding company. Its main asset is actually Tencent, which is a social media and gaming platform, but it has a couple of companies which are based in Russia. And for one of those, it's had to write off the entire value of that. But again, it's a very, very small percentage of its actual net asset value. And then it's kind of the second order effects and the indirect effects. We obviously have companies which will be affected by higher energy prices. And we have two airlines, for instance, in the portfolio as well. So we have some exposure to what's going on. But again, we have quite a diversified portfolio. We have lots of not just technology companies, which are relatively asset light. We have lots of global industrials. We have med tech companies. And these companies have been operating in emerging markets where they've had to put up with quite volatile inflation, interest rates, and everything else for decades. So, it's a horrific set of events which are unfolding in front of us at the moment, but the actual effects on the portfolio are pretty limited.
And final question, will Europe's green aspirations now take second place to breaking its reliance on Russian hydrocarbons, or is that two sides of the same coin, do you think?
Yeah, I think they're both the same thing. I think even before the European Commission and the politicians had been kind of ratcheting up at least the rhetoric about trying to progress Europe and kind of helping Europe become the leader in this kind of climate transition. And as I said, I think what's happened in Ukraine has really just accelerated this. And we're also kind of hearing this from companies as well that believe and understand that this is happening, and hopefully that this will benefit society, at least from a climate standpoint as well. So this is why I think we're kind of continue to focus on those companies which are going to enable that transition as well. So I think it's time for the European politicians to finally show what they can do.
Excellent. You can always rely on politicians to do the right thing, can't we? Stephen, thank you so much for joining us today. That's all we've got time for, I'm afraid. Thank you for your time and insights. And thank you also for watching and your questions that you've sent in. We do have more sessions like this coming up, so please do keep an eye out for those if you found today's session useful, which I hope you did. And that's all from us today, so I'll bid you goodbye from London.